Ever wondered what it'd be like to be a full-time trader and make money whilst you're sipping champagne by the pool, or making thousands of pounds in just a few minutes, then taking the rest of the day off? Well, take those dreams and put them in the bin, because that's not reality. And whilst I have made money trading by the pool or on a remote island in the Seychelles, because I can trade from anywhere in the world, unlike trading gurus, I won't hold anything back and I'll tell you exactly how it is. But before we get to the good stuff, it wasn't always a load of fun. Back in 2016, I bought shares in a stock called Management Resource Solutions, and it was an undervalued picks and shovels play to the expanding mining industry in Australia. But I remember getting on the U-Bahn after a hard day of cold calling people, trying to recruit them into jobs, and seeing that the stock had suspended due to accounting irregularities. Basically, I got a sinking feeling in my stomach and my chest went tight, because I was pretty certain I'd just lost more than my annual salary in a single trade. And that was the first lesson, and I realised that when I went full-time on the markets a month later, I'd need to avoid taking large positions in any stock, because if something like that happened again, it could seriously damage me. But I bounced back because the market was buoyant, and in early 2017 things were making incredible moves. I rode URU from 0.4 pence to 4.4 pence, which was a complete crock but a market darling. And there was another stock that owned Melody VR, which did virtual reality gigs. That went up a few %, as well as Innovaderma, which more than tripled. And what it taught me was that making money in stocks was easy, and I recycled the profits into other stocks and took on bigger and bigger positions. I'd already decided what colour my Ferrari was going to be. It was going to be red. And I thought it would never end. Well, unfortunately, it did, and the 2017 general election caused a huge amount of uncertainty. Basically, liquidity evaporated, and those huge positions that I had, I struggled to sell, and had to mark the price down on every sell. I hated the opening bell because it meant I'd be losing more money. I had a constant tight feeling on my chest. I was irritable with my wife, and it really was just a horrible time. Then one day I couldn't take the losses anymore, and I just got rid of everything, because if I kept it up I'd be going back to my job, which was actually more scary than crystallizing massive losses. I instantly felt better, and I knew that if I wanted to do it seriously, then I needed to take a more structured approach and run this as a business, and that psychology really is everything. Because I'd made so much so quick, I got complacent and I took on bigger and bigger risks, and it inevitably came crashing down. So it is important for anyone with the goal of making the jump to full-time on the markets to properly assess their financial situation and personal strengths and weaknesses before committing fully. I think it's better to not do what I did and instead move to part-time work before jumping in with both feet. This is because it's easy to get used to a healthy salary, and if your trading account gets low, there's always a tap ready to fill it back up. That's not the case when you turn your back on employment or your profession and eat what you kill from the market. You absolutely will have losing months. Every trader has them. Don't believe anyone who says they don't. But those bills do need to be paid, and you've now got a smaller account. Don't underestimate the heightened emotions once you cut off all other income either. And so going part-time or starting a side income is a useful distraction and pressure reliever before total dependency on the market. Any losses, anxieties and uncertainties will be amplified heavily once you step into the ring. One of the questions I often get asked a lot is, how much do you need to trade full time? And unfortunately, there's no single right answer. It does entirely depend on your personal and financial circumstances and your expected returns for the year. But there is a way that we can calculate that and come to a decision by using my financial audit sheet, available in the link below. And what you do is you list all of your monthly expenses, total this up, and then you multiply this number by 1.2. This means that we add 20% extra to our monthly expenses, which insulates ourselves against expense shock and gives us a conservative figure. We then multiply this by 12 in order to get the total monthly costs for the year. Next, do the same exercise for the annual expenses, then multiply this by 1.5. This extra 50% factors in a healthy safety net because there are always unavoidable and unexpected costs which pop up. So once we've got these two figures, we total them up to give us our total costs figure, our TCF, which is what we need to pay our bills and includes our disposable spending. Take this figure, double it, and this gives us our annual profit target, or our APT. Now the reason we're doubling our TCF to get to our APT is because we need both to give our target some leeway should we fall short, but also as traders we need to compound our accounts. Now if we need 15% returns to pay our bills and we achieve 15% returns, our account hasn't actually grown and we're in the exact same position as we were at the start of the year. And it's no good breaking even every single year. We need to be building our equity curve upwards and growing our net assets. So we now need to divide the APT number by our available funds, but note that this does not include leverage. For example, if you have £100,000 available to invest, then this is your available funds. Just because you can leverage that to £400,000 as a retail client and more as a professional doesn't mean that you should class this as your available liquidity. And once you've divided your APT by your available funds, you get the number you need to be aiming for in your first year. Now if the number is above 0.2, you should seriously consider if full-time trading is for you, and this is because you will require an annual percentage return of over 20%. It's achievable, but ideally we want to give ourselves a nice cushion and set our targets low. That way we both buy ourselves time but also have the benefit of enjoying significant account growth. We also don't put ourselves under as much pressure, which is proven to stunt performance. Now ideally the lower the percentage required to hit your APT, the better. So you're probably thinking, how can I improve my odds? Well, firstly you need to take another look at your expenses, decide what are needs and wants, and try to remove as many needs into the wants section as possible. The lower your costs, the more available runway you give yourself. Secondly, try to boost your income elsewhere. Maybe there's some consulting you can do or a side hustle. I know people who buy and sell Pokemon cards on eBay as well as run Amazon e-commerce businesses. Again, this does improve your runway. And then once you've come to a final figure, evaluate your performance over the course of your career and see if your APT is realistic. If you've barely struggled to hit 10% over the last several years, having more time won't necessarily mean your returns are increased. In fact, I have one investor friend who wasn't able to work during lockdown and he found he had too much time to tinker. Post-lockdown, working kept him busy and the stock market was no longer a distraction. So too much time is a real issue. Finally, it makes sense to have a financial buffer outside of your available account funds so you are not drawing down from your funds immediately. And secondly, you also need to be sure you have the right environment. You absolutely need your spouse on board and you need to be honest with them and tell them about the risks and what could go wrong. This can be a difficult conversation, especially if you have to convince someone else that the lifestyle that they've become accustomed to is not only under threat, but is actively being downgraded by you in order to give you a better chance of trading profitably. And without the support of your spouse and immediate family, you will likely fail, so you do need total support here. And if you're sure you want to transition to full-time on the markets, then you need to set yourself up as a professional. That means investing in hardware. If you're using a laptop screen, then I'd suggest buying at least one external monitor. I use ultra-wides and a wired mouse and keyboard. Now the wires aren't as tidy as wireless, but the advantage of wires means that you'll never run out of battery or power because you forgot to charge your mouse or the batteries have ran out. You then need trading and investment software, so I recommend SharePad, and you can get a 1 month free trial through me with the link below, and this allows you to filter for stocks on both technical and fundamental indicators and ratios, as well as create watch lists, set alerts and alarms, and monitor your account. It does do a lot of the heavy lifting and removes the manual work, and the more ground you can cover and outsource efficiently, the more effective in the market you'll be. Now you also need to ensure you've got a good mix of resources readily available both for idea generation and to stay on top of current events and stocks. So making free use of resources such as Investor Meet Company and PI World can keep you up to speed on management calls and presentations, as well as a premium platform such as Research Tree, which you can trial free with the link below. There's also the Small Caps podcast with Paul Scott, which summarizes much of the news he's looked at in one piece and creates an easily digestible listen. And whilst you shouldn't follow anyone blindly, myself included, Paul's quite good at picking apart the financials of companies, which is useful for checking if there are any potential red flags. There are also 2 free newsletters I'd recommend alongside my own: Small Caps Life Weekly and the Friday Speedrun by Brent Donnelly. The former looks at the UK small caps and summarises news of the week, as well as some analytical detail. The latter is a macro-based, light-hearted mix of education and analysis, and you should constantly be looking to refine your sources of information. At the start, information is so abundantly available, it can feel like a fire hose pressed against your face, but filtering and working out what's necessary is crucial if you are going to exploit this information to your advantage. Having a network of investors and traders to speak to and chatting with others who are in the business regularly can definitely help to learn about different parts of the market and even get ideas. Again, you shouldn't copy anyone, but use the information, verify it for yourself, and decide if it meets your risk to reward strategy and trading objectives. It's no good if someone's found the best stock in the world if their time frame is 5 years and most of your trades are complete within 5 months. But learning about the market that you hunt in is imperative. Now, I've followed some stocks for years and only traded them a handful of times, sometimes only having exposure to the stock for just a few minutes, but those trades were only possible because I was aware of the stock and knew what it did as well as the current narrative, and I was able to contextualize that new piece of information quickly when it hit the market. So it is possible to gain an edge on some trades just by outworking everyone else, and it also pays to be aware of all the biases that will be exacerbated when you make the move to trading full time. Recency bias can cause stock market participants to overweight new information that just doesn't deserve it. Another common issue is confirmation bias. This is looking for information that suits your point of view, which you can see in abundance on bulletin boards. Now, we're at our most objective before we place a trade, and once the trade is open, we're a big bowl of bias bolognese because we've both got an emotional and financial interest in being right. So to combat both of these biases, you can log your trading activity and set targets, but even then, recency bias can mean traders can place far too much importance on their last couple of trades. The results from your last 10 trades are down to variance, but 100 trades collected is data. You need to be constantly thinking about the next 100 trades rather than focusing on the results from 10. However, that doesn't mean that you should ignore the data, because this data can be studied and improved upon. You can do this with a free trading tool called TradeSmash. Again, the link is below. Recording your trades is the single best thing any stock market participant can do, as without the data, there's no way of knowing if you're exiting too early or if you're sticking to your plan, or even if you have an edge at all. For example, you might find that all of the positions you close are running up a lot without you in them, without pulling back much, which means you're taking money from the table too early, but you could only know that if you logged your trades and studied the data after the trade was closed. Making the market your main source of income does mean it needs to be treated as a business. That means a set schedule that must be kept to diligently, and having a schedule means that you can follow it regardless of how tough the market is, as there will inevitably be ups and downs, and full-time trading is as much money and psychological management as it is looking for stocks to trade. But this video has been a lot to take in, and if you're still interested in trading, you can download my free UK stock trading handbook below. YouTube says you might like one of these videos, so thank you very much for watching, and hopefully see you in the next one.